Hello and welcome to Genius Indian. Friends, today we are going to discuss carbon tax. This is a relatively new concept and it is concerned with the burning of carbon based fuels like coal, oil, or gas. The simplest definition of carbon tax is that it is a fee on the carbon content of fossil fuels. It is a levy applied to fossil fuels based on how much carbon dioxide they release when they are burnt. Carbon tax is a form of a pollution tax, and its main purpose is to reduce greenhouse gas emissions. And to achieve that goal, it levies a fee on the production, distribution, or use of fossil fuels based on how much carbon their combustion emits. Carbon tax is one of the two major options to lower the emissions, the other being cap and trade scheme. Both of these systems have their pluses and minuses, and both of these systems have their own detractors and followers. However, many economists and consumers prefer the carbon tax for its simplicity and impartiality. The government sets a price per ton on carbon and then translates it into a tax on electricity, natural gas, or oil. As you can understand, the tax makes dirty fuels more expensive, and as a result, it encourages utilities, businesses, and individuals to reduce the consumption and to increase energy efficiency. Carbon tax also makes alternative energy cost competitive against cheaper and polluting fuels like coal and furnace oil. Carbon tax is based on the economic principle of negative externalities. Externalities are the costs generated by the production of goods and services. And on that score, negative externalities are the costs that are not paid for. Negative externalities are the costs suffered by a third party as a consequence of an economic transaction or an economic activity between the first party and the second party. As you know, in a transaction, the producer and the consumer are the first and the second parties, and the third party includes any individual or an organization or a property owner or a resource that is indirectly affected. When an industrialist who is producing chemical dyes dumps pollutants and untreated effluents in a nearby river, he simply destroys the river and causes serious health injuries to people living downstream and people drinking and using the water of that river. And by doing so, while he saves all the money that should have been spent on disposing of the effluents properly, the river water consumers spend tons of money to fight the effects of those pollutants. And this cost is known as negative externalities. Similarly, when utilities, businesses, or homeowners consume fossil fuels, they create pollution that has a societal cost. And it's called societal cost simply because everyone in the society suffers from the effects of pollution. Even a poor tribal in Bastar district suffers from the pollution generated by excessive car fuel burnt by a rich industrialist in Mumbai or in Delhi. The tribal suffers without even owning a car or enjoying a car ride or burning any fossil fuels, simply because everything in the environment is interconnected and simply because pollution at one place is pollution at every place. Proponents of the carbon tax say that the price of fossil fuels should account for all those societal costs. Simply put, if you are polluting the environment, which belongs to everybody in this world, then you must pay for it. Carbon tax slaps an extra fee on fossil fuels based on how much carbon they emit. And in order to escape these extra fees, users will either reduce the usage of the fossil fuels or switch to alternative energy solutions. An individual might switch to public transportation and replace old-fashioned bulbs with CFLs or LEDs. A businessman may increase energy efficiency by installing new appliances, new machineries, or updating heating and cooling systems. An industrialist may switch to solar or wind energy sources simply because the carbon tax makes the fossil fuels more expensive. As we can understand, the carbon tax raises extra revenue for the government. The government gets extra income which it can use to subsidize environmental programs or promote other green energy projects, or simply return it to the people the way it is done in Canada. The Canadian government imposes carbon tax on polluters and then it refunds most of the revenue earned this way to individual Canadians on their tax bills. Which simply means, on one hand, the Canadians pay slightly higher energy bills, but then they are also compensated with slightly lesser income tax. Similarly, our country introduced a nationwide carbon tax of 50 rupees per ton in 2010. This was increased to 100 rupees per ton in 2014, and then it was further increased to 200 rupees in 2015, and as of 2019 it stood at 400 rupees per ton. Now, 400 rupees may not seem much, but remember that our country produces and consumes almost 600 million tons of coal every year. So the government receives a huge amount from the tax, which it can spend on projects that are necessary for the development of our country. For example, from year 2010 to 2017, the government of India collected about 86,400 crore rupees through the Clean Environment cess, out of which some money was transferred to the National Clean Energy Fund and some to the Ministry of New and Renewable Energy. As I said earlier, economists like carbon tax for its simplicity and predictability. The price of carbon under the cap and trade scheme can fluctuate with weather and with the changing economic conditions. This happens because cap and trade schemes set a definite limit on the emissions and not a definite price on the carbon. And besides, the price of emissions permits can fluctuate in the secondary market, either due to someone willing to pay a higher price or because some speculators having entered the market. On the other hand, carbon tax is stable, irrespective of the limit on the emissions. You pollute more, you pay more, as simple as that. Carbon tax also helps the businessmen. Businesses and utilities know the price of the fuel before launching their projects, so they have a clear idea of the natural costs and the fuel costs, whereas in emissions trading, the costs can keep changing. And of course, this knowledge can also spur them to invest in alternative energy and technologies that increase energy efficiency. And finally, it is also easier for people to understand the concept of carbon tax and the way it works. And that's why, as of now, dozens of governments worldwide have adopted some sort of price on carbon, either through direct taxes on fossil fuels or through cap and trade programs. Carbon tax is widely accepted in northern European countries. Denmark, Finland, Norway, Poland, Sweden, and the Netherlands, all of these countries tax carbon in some form or other. However, the tax structure differs from one country to another. Some impose tax on manufacturers and producers, whereas others impose it on consumers. For example, Sweden taxes the consumption end. The national carbon tax charges homeowners a full rate and half the rate to the industries. So friends, this was a brief intro to the concept and the workings of carbon tax. In the next episode, we will discuss yet another topic important for our personal and professional growth. So please don't miss it. And the best way not to miss it is to subscribe to Genius Indian channel. And the best way to spread the knowledge is to like and share the video. And the best way to improve the quality of the work is to provide your valuable feedback. And finally, the best way to end this conversation is to thank you for your valuable time. Thanks for watching.